While defense has been one of the biggest investment theme over the last few years, another segment that has quietly started gaining momentum is precision aerospace manufacturing. And the opportunity here is much larger than simply supplying to India's defense ecosystem. I remember covering aerospace and defense sector and top companies last year. But in this video, I want to focus especially on aerospace segment. Every commercial aircraft, whether it is an Airbus or a Boeing, contain millions of precision engineered components. Once a supplier gets approved, these relationships often last for decades, creating a business with high entry barrier and sticky customers. Today, global aerospace demand is stronger than it has been ever in years. Airbus and Boeing together have order backlog exceeding 17,000 aircraft, giving suppliers visibility that stretch well into the next decade. At the same time, global companies are diversifying manufacturing beyond China, and India is emerging as one of the strongest beneficiaries. So in this video, we'll first understand why aerospace manufacturing could become one of India's most interesting long-term opportunity. And then we'll deep dive into 5 listed companies working in precision aerospace segment. But before we begin, one important disclaimer. This video is purely meant for educational purpose and to help you understand these businesses better. It's not a buy or sell recommendation. Aerospace is undoubtedly an exciting long-term theme, but that does not automatically make every aerospace stock a good investment. Your business quality, execution, valuation, and future expectation can vary significantly from one company to another. So use this video as a starting point for your own research. Read the annual reports, understand the risk, track the business over time, and then only invest if it fits your own investment framework and risk appetite. Another important aspect is, whenever a new investment theme starts gaining popularity, whether it's defense, railway, or now aerospace, many investors immediately start looking for the best stock to buy. But investing should ideally begin with your financial goals, not with a trending sector. These days, the topic of retirement is being discussed extensively online. There are different point of views on how much is enough to retire comfortably in India. Some believe 5 crore is enough. Some may believe 10 crore is enough. But honestly, it's not one single number, but depends on each individual or family. It depends on your monthly expenses, where you live, inflation, your key life goals like buying a car, home, education, wedding, and many other factors. While we invest regularly and spend time and effort on building our portfolios, it is equally important to start thinking of retirement planning. How much corpus you will need and at what age you could potentially retire. You can estimate your retirement goal on Deserve app with ease. It's a great app to track and monitor your investment portfolio. They have also introduced a feature where you can plan for your retirement on the app, which considers your current portfolio, age, monthly expenses, retirement timeline, and other inputs. The app then provides an illustrative estimate of your retirement corpus. I checked it out myself and I was honestly surprised by my retirement number. You can also check out this feature and start planning for your retirement. You can download the app from the link in the pinned comment. With that in mind, let's now understand why aerospace is a big opportunity. So the first reason is simply demand. Global commercial aviation is entering one of its strongest growth phases in decades. Airbus and Boeing together are sitting on an order backlog of more than 17,000 aircraft, representing almost 12 years of production at current manufacturing rate. This means aircraft manufacturers already have enough confirmed order to keep their production line busy for the next decade. According to Airbus' latest forecast, the world will require over 43,000 new commercial aircraft over the next 20 years. So this is not just 1 or 2 year cycle. It is a structural demand story that could play out over the next couple of decades. Then second reason is changing global supply chain. For decades, global aerospace OEMs depended heavily on a handful of manufacturing hubs. But after COVID, supply chain disruptions and rising geopolitical tension, companies have actively started diversifying their sourcing beyond China. And India has emerged as one of the strongest beneficiaries because it combines skilled engineering talent, competitive manufacturing cost, and an improved industrial ecosystem. As a result, companies like Airbus, Boeing, Pratt & Whitney, Rolls-Royce are increasingly sourcing complex high-value components from Indian manufacturers. This gradual shift is opening a much larger export opportunity for Indian aerospace supplier. Then third reason is aerospace is a very high entry barrier business. Unlike many engineering companies, you cannot simply buy machines and start supplying to global aircraft manufacturer. Every component has to meet extremely stringent quality standards because even the smallest defect can have serious safety implication. Getting approved by an aerospace OEM often takes several years. Companies need specialized manufacturing capabilities, multiple certifications, rigorous testing processes, and an exceptional quality record. Even after qualification, every manufacturing process continues to be audited regularly. While this makes entry difficult, it also creates a significant competitive advantage for companies that have already crossed these barriers. Then fourth reason is the stickiness of the business. Once a supplier gets approved for a particular aircraft or engine platform, that relationship often continues for decades. Aircraft programs typically remain in production for 20 to 30 years, and customers are generally reluctant to change suppliers because requalifying a new vendor is both expensive and time-consuming. This results in long-term revenue visibility, high switching costs, and relatively stable customer relationship. And finally, this opportunity is not just limited to commercial aviation. Global defense spending has been increasing over the last few years due to rising geopolitical tension. Aircraft engines, fighter jets, helicopters, and various defense platforms require many of the same precision manufacturing capabilities that are used in commercial aerospace. This allows several Indian companies to benefit both from commercial aviation and defense manufacturing. So when you combine a multi-decade aircraft demand cycle, supply chain diversification, extremely high entry barrier, sticky customer relationship, and growing defense spending, it's easy to see why aerospace manufacturing has become one of the most interesting long-term manufacturing theme for India. Now the obvious question is, which listed companies are best positioned to benefit from this opportunity? Let's discuss it. So the first company is Unimech Aerospace. It's a precision engineering company that manufactures highly complex mission-critical products for global aerospace and defense OEM. Broadly, this business operates in two segments. First is aero tooling, which contribute around 90% of the revenue. There are two major categories of tooling: aero engine tool and airframe tool. These are specialized tools used during the manufacturing, assembly, maintenance, and repair of aircraft. These products are not installed inside the aircraft, but they are essential for building and maintaining aircraft safety and efficiency. Its second segment is precision component and assemblies. Here the company manufactures high precision component and electromechanical assemblies that are used across aerospace, defense, nuclear, and semiconductor industries. These are typically low volume but high value products that require extremely tight manufacturing tolerance. As far as financials are concerned, while both its revenue and profit growth was explosive between 22 to 24, it has struggled to grow, especially in last 1 year. And margins have also reduced. But this lumpiness would be part of the journey. Company recently launched its IPO at 785 and had a bumper listing with 86% premium. However, the valuation became too expensive, and since then, the stock has underperformed. In fact, even today, they command a very high valuation. But it is also a fact that the opportunity for Unimech is immense. Not just in aerospace, but also in semiconductor, nuclear, and defense. Company's management aspired to clock 1,000 crore revenue by FY29. In FY26, they have achieved 240 crore. So that is a very ambitious target. Let's see how much they can achieve. If you look at the shareholding pattern, promoters have huge skin in the game, but institutional holding is very low at the moment. Then second company is Dynamatic Technologies. It is one of the oldest and most established players in India's private aerospace manufacturing ecosystem. It is one of India's few manufacturing companies where they manufacture flight critical aerostructure. Today, Dynamatic supplies these aerostructures to some of the world's largest aerospace OEMs, including Airbus, Boeing, Bell Helicopter, Dassault Aviation, Deutsche Aircraft, and HAL. However, one thing you should understand is that Dynamatic is not a pure play aerospace company. While aerospace contributed around 48% in FY26 revenue, rest of the businesses come from hydraulics and metallurgy businesses. Aerospace has emerged as fastest growing and highest quality segment. But the other two businesses have been relatively cyclical, and this has been reflected in company's financials. Company's revenue growth has not moved much in the last few years, and operating profits have also been flat. Its return profile is also weak at the moment, and debt levels are also elevated. But in spite of weak financials, its stock price has rallied a lot in the last few years, and currently its valuations are extremely high on every parameter. Unfortunately, management do not conduct con call, so we don't have any future guidance plan. Its shareholding pattern suggests decent allocation of management along with good institutional holding. Recently, FIs have reduced some holding and DIs have added. Overall, while valuations are a concern, Dynamatic's growing capability in high-precision aerostructure manufacturing is definitely worth watching closely. Third company in the list is Azad Engineering. Azad specializes in manufacturing mission-critical components that operate under extreme hard conditions inside aircraft engine, gas turbines, and defense platform. These are components where even the slightest fault can result in loss of lives and billions of dollars. That's why there are only a handful of companies globally. Please note that Azad is not a pure play aerospace company. In FY26, 81% business has come from oil and gas segment. Aerospace and defense contributed around 17%. However, aerospace and defense segment has been growing at a much faster pace. Export contributed around 93% in company's FY26 revenue. Within aerospace, it manufactures precision components that are used within the aircraft engine, like turbine airfoils, unison wing, engine assemblies, housing, compressor, etc. Its components go into aircrafts like Boeing 737, Airbus A320 family, Airbus A350, and so on. One of the biggest strengths of Azad Engineering is strong entry barrier. Since the precision components are mission critical, with some parts having 0 parts per billion defect requirement, the entry barriers are very strong, where supplier takes years to qualify for manufacturing. And once the supplier earns that qualification, it is very sticky, multi-year and high-value business. If you look at company's financials, its revenue has jumped nearly 5 times in last 5 years, and profits have exploded nearly 10 times due to margin expansion. Trailing 12-month revenue growth was 32% and profit growth was around 52%. Azad got listed in 2023 with issue price of 524. It immediately jumped 3 to 4 times. That made the valuations very expensive. However, stock has consolidated for almost 2 years and recently jumped from the April lows. But the valuations are still expensive on every parameter. Having said this, the kind of growth company has delivered and the quality of business it offers, it will command a premium. Company's management has guided for around 25% CAGR growth in revenue for the next few years with margins in the range of 33 to 35%. So it's a high growth company available at premium valuation. Its promoters have high skin in the game and even institutional investors have good holding. Although FIs have slightly reduced some stake in the last couple of quarters, but that is absorbed by DIs. Then fourth company is Aequs. Unlike other aerospace companies that were mainly into one or two aerospace category, Aequs has built a vertically integrated aerospace manufacturing ecosystem, allowing it to manufacture a wide range of precision components and assemblies under one roof, including engine components, landing gear parts, aerostructures, wing and fuselage parts, actuation system components, and interior components. Aequs operates India's only aerospace-focused manufacturing ecosystem within a single special economic zone at Belagavi. However, please note that Aequs is not a pure play aerospace company. Alongside aerospace, it also has consumer manufacturing business, including toys, consumer electronics, plastics, and consumer durables. While these businesses provide diversification, the aerospace segment remains company's biggest profit driver and the key reason most investors are interested in the company. If you look at the financials, first of all, we have only 4 years of data, and that too it is not very impressive at the moment. Its revenue growth has been average between 22 till 25, but trailing 12-month growth is impressive. Its margins have actually declined and that resulted in degrowth in operating profit, and company is currently reporting losses at PAT level. In spite of that, company share price almost doubled in last few months from March lows. Please note that company's aerospace business is profitable, but its consumer business is at loss. Company has also invested aggressively in capex, that is another reason for fall in margin. And third reason for loss is high interest and depreciation cost. So the key question today is whether the current investment in business can generate sufficient return in future or not. Company's management has a bold vision for 2031 where they aspire to grow revenue 4 to 6 times and take EBITDA to 18 to 22% with 20% ROCE with consolidated PAT break-even expected in H1 of FY28. So at the moment, it is too early to take a call, but certainly the business is exciting and worth keeping a close eye. Final company in the list is an auto auxiliary business that is gradually expanding into aerospace manufacturing. Company name is Sansera Engineering. I've discussed Sansera in the past. Company has spent decades building expertise in precision manufacturing, complex forging, advanced manufacturing, automation, and quality control while supplying to some of the world's largest automotive OEMs. Many of these manufacturing capabilities are directly transferable to aerospace, where precision, consistency, and reliability are equally important. Sansera manufactures precision engineering components used in aircraft engine, airframes, and defense application. However, aerospace contributed only around 310 crore in FY26 versus company's overall revenue of around 3,500 crore. So aerospace contribution is less than 10% of company's overall revenue at the moment. But this segment is expected to grow nearly 2 times in FY27. Sansera's overall financial has been solid, including both revenue and profit. And its stock price has jumped significantly in last 1 year, mainly due to significant valuation re-rating due to growth in aerospace vertical. However, in my opinion, today the valuations are quite stretched to consider fresh position. So to summarize, all these companies offer exposure to aerospace opportunity, but the nature of that exposure is very different. Unimech and Dynamatic derive a significant part of their business for aerospace. Azad and Aequs have strong aerospace franchise, but they also have sizable business outside aerospace. And finally, Sansera is primarily auto engineering company that is gradually building its aerospace vertical. So coming to the most important question, are these good investments today? So from a business quality perspective, I think the opportunity is genuinely exciting. The global aerospace industry has multi-year demand visibility, entry barriers are extremely high, customer relationships are sticky, and India is gradually becoming an important part of the global aerospace supply chain. These are exactly the kind of structural theme that long-term investors like to track. However, investing is not just about buying a great business. It is about buying a great business at a reasonable valuation. And that's where I think you need to be a little careful today. Aerospace has become one of the hottest themes in the Indian market. As a result, many of these companies are trading at very rich valuation. Another point you should keep in mind is that aerospace manufacturing is rarely a smooth quarter-on-quarter business. Orders are often program-based, customer approvals takes time, and revenue recognition can be lumpy. So temporary slowdown in growth or margin should not come as a surprise. In addition, many of these companies are currently investing aggressively in new capacity. While that creates long-term growth potential, it can also increase depreciation, interest cost, and execution risk in the near term. So personally, I find the businesses more attractive, but the valuations less attractive at the moment. That does not mean these companies should be ignored. In fact, I think they deserve a place on every serious investor's watch list. The key is to track their execution, monitor whether they can continue winning new programs, watch how revenues and margins evolve over the next few years, and most importantly, wait for opportunities where the valuations offer a better margin of safety. Because in investing, a great business can still turn out to be a poor investment if you pay too high price. So that's it from my side. Hope you'll find this video useful. Also, for more details on retirement planning, you can explore Deserve app. Link is in the pinned comment. The views and opinions expressed are my own and does not reflect or represent the views and position of Deserve Investment Private Limited or its affiliates. The information contained in this video is for general and information purpose only and is not meant for advisory or recommendation purpose.